Hi, this is Pragati. Your interest in the world of stocks must have had you come across jargon such as earnings and yields, right? So, following that, in this video, I will try and simplify a very important concept relating to these two jargons, that is the Bear ratio. But before we dive into what it really means, I would like you to like, share, and press the bell icon below. Now, don't get too excited about the Bear in the ratio. It is just an abbreviation for bond equity earnings yield. Now, as the name suggests, it evaluates the relationship between bond yields and earning yields in the stock market. We will start with understanding what these two individually mean. So, bond yields are basically the yield from the bond. For this, we typically look at the 10-year government bond yield, which is currently hovering around 7.2%. Earning yields pertain to the equity, which is the inverse of PE. So, the inverse of PE would be EPS upon the current market price. Now, considering the average PE for the past 1 year of 21.25, the average earning yield would be approximately 5%. That is, for every rupee invested in the stock, the equity generates 5% as earning yields. Now, to simplify it further, say if a stock is priced at rupees 100, it generates rupees 5 as earnings. Now that we know what bond and earning yields mean, the next step is to get a sense of the relative benefits. So theoretically, Bear ratio of less than 1 indicates that the underlying stock benchmark is undervalued, because it means that stock earnings are more than bond yields. So say if you invest rupees 1 in equity and bonds, equity will generate more money. Thus, this condition indicates equity market is more attractive. So similarly, if the Bear ratio of more than 1 indicates the opposite, that is, the bond yield is greater than the equity earning yields, which could possibly mean that the given stock benchmark is overvalued. So say if you invest rupees 1 in equity and bonds, bond will generate more money. This makes bond more attractive. This relationship between bond yields and stock earnings can also be seen as a difference between the two. So the basic idea here being that stocks and bonds compete for investment dollars. Say with the stocks being favored when interest rates are low and bonds being favored when the interest rates are high. So when this difference widens, the bond yields are higher than the stock earning yields, which means that the bonds are favored with higher interest rates, thus yielding higher earnings, which also might mean a correction for the underlying benchmark stock index. Also, when these bond yields are invariably higher than the usual stock market yields, the correction might then mean a stock market crash. Looking across historical data, the ratio has recorded a high of 1.75, with bond yields ranging around 7.8% and earning yields between 4.2 to 4.5%. As for the current scenario, the Bear ratio is at 1.5, with bond yields at 7.2% and earning yields at 4.8%. So now to conclude, as the bond yields and earning yields fluctuate over time, this ratio can provide crucial insights into potential corrections or even market trends. And it can also empower you to make sound investment choices aligned with your financial goals. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.